vividly remember a day when I was in college and my finance professor proclaimed to the class that there is no way to predict the stock market. In his words, it's a complete crapshoot. Now, my initial response was to wonder why I was bothering to take a finance class. I mean, if this guy who has his PhD in finance from an Ivy League school compares the American stock market, the basis of our economy, to a casino, then really what's the point? Now, thankfully, he provided more context that his ultimate point was that over the short term, stocks are unpredictable, but over the long term, many years, stocks are actually a pretty safe way to invest. And we're going to show you why that's true, but first I want to clarify what I mean by stocks. So as you probably already know, stocks are individual shares of ownership in a large company. They are traded typically in exchanges like the New York Stock Exchange or electronically on the NASDAQ. And trillions of dollars of the American economy is tied up in the value of stocks. But when we use the word stocks in this video, we're not really referring to individual stocks by themselves. You see, the ultimate point of this video is to show how owning stocks over the long term can reduce the impact of market risk. That is, risks that outside events will impact the prices of stocks on a short-term basis or day-to-day basis. Some things include things like wars in other countries, political elections, economic factors like unemployment, interest rates, things like that. All of these impact the cost or the price of stocks that we see on a day-to-day basis. What we're not going to focus on is concentration risk, which is having so many or a large portion of your investments in individual stocks, so that if the price of one stock goes up or down because of something that impacts one company, it doesn't hit you quite as hard. For example, recently Alaska Airlines had a flight that a panel actually flew off the plane. It was a Boeing airplane. Both Alaska Airlines and Boeing stocks suffered greatly in the weeks that followed that incident. If you'd have had a large portion of your investment portfolio in Boeing or Alaskan Airlines, you would have taken quite the beating in the last few weeks. Most of the time, people avoid this risk by buying exchange-traded funds or mutual funds. They buy a basket of stocks or lots of different companies and hold that in their portfolios, so that if one company has a bad day or they lose part of their plane, it doesn't impact their portfolio too negatively at one time. It's important to make this distinction because I don't want you to watch this and think that you need to go out and buy individual stocks and just hold them for a long time and assume that you're going to generate some great return. What we're talking about is actually holding a basket of stocks or owning the whole stock market in a mutual fund or other investment that will produce a long-term, safer return. A great example is the Vanguard Total Stock Market Index Fund. I think it's VTSAX. Others are like S&P 500 index funds. These are mutual funds or investments that own a large portfolio of individual stocks to avoid concentration risk. All right, with that out of the way, let's talk first about why owning stocks over the short term is actually akin to gambling. Visualizing how short-term ownership of stocks is like gambling is pretty easy. Just go to Google, pull up any stock you can think of, and you'll see a chart pop up that will basically show the price fluctuations of that stock over some period of days. I think usually Google pops up for the last 5 days, but then you can adjust it for 1 day, 5 days, a year, 5 years. There's different ways you can spread that out. When you do that, you're probably going to see something that looks like an EKG from a hospital or a cardiologist's office with it up and down and up and down. So for an example, I used Coca-Cola. It's on your screen now. You can see over a 5-day period back in January, its stock price went up and down, up and down. And in the short term, that's generally what stocks do. But the thing that's important to understand is why the price of stocks goes up and down. And it's important to understand that because it can't be understood. You see, in the short term, the price of a given stock is dependent on the number of buyers and sellers that are in the market for that stock. On the day that I actually looked this up, Coca-Cola had more sellers than buyers. So the price was going down because of supply and demand. There were more people trying to sell the stock than buy it, so the price came down to accommodate the fewer buyers that were in the market. Now tomorrow, if there are more buyers than sellers of Coke stock, the price will go up. And this can change for any number of reasons. There is literally an infinite number of things that could impact the price of a stock on a day-to-day basis. There could be a war in another country. There could be an outcome from a political election. There could be data released about unemployment in the United States. A famous athlete could be seen drinking a Coke somewhere. The price of aluminum cans could go up. There could be a flood that damages a bottling company somewhere. There's so many things, and the list is endless. And there's no way to predict most of these things. And since you can't predict the things that impact the price of the stock, you can't predict what the price of the stock is going to do. It's impossible. And the really wild thing is there are actually people out there who think they can outwit or outpace the rest of the market, which is patently ridiculous. First, we've already covered how there's an infinite and unpredictable number of things that can impact the price of a stock. But even if you got the news first, even if you were the first one to hear the news about the price of the stock, by the time you log into your E-Trade account and make a trade of that stock, there are thousands of traders down the street from the New York Stock Exchange who will beat you to the punch. Actually, one of the worst things that can happen is that you see some news, make a trade based on that news, and actually make money after that, thinking it had something to do with your response to what you learned. Because then you're likely to repeat the mistake. I mean, to me, there really is very little difference between trying to flip a stock on like a day, like you buy it low and try to sell it high that afternoon, and walking into a casino to the roulette wheel and putting everything you have on black. There really is no difference because you do not know what the outcome is. And even if you are successful, you cannot explain why that occurred. You might win, you might lose, but in the end, it really is just luck. Now let's drive this point home a little further. Earlier I talked about how we weren't going to refer to individual stocks, and then I showed you Coca-Cola Company. So let's look at an index, the S&P 500, over a 5-day period as well. Now this is the same 5-day window we had for Coca-Cola earlier in mid-January of 2024. As you can see, the S&P 500 actually did well over this period, but it's still up and down, maybe not quite as drastically. But there's not a clear indicator of when you should or shouldn't buy from a day-to-day basis. There is a smoothing effect on the price of the stock based on the fact that S&P 500 is a basket of 500 stocks and not just a single stock. But nevertheless, the price goes up and down. If you'd have bought it on the 17th, you'd have done pretty well by the 22nd. But if you bought on the 16th and sold on the 17th, you would have lost money. Again, it just depends on a lot of factors that you can't predict. Now, the same things that impact the Coca-Cola stock on a day-to-day basis impact all the companies that are listed in the S&P 500. It just hits them a little differently. Even with the concentration risk eliminated from the S&P 500 index, buying and selling it on a day-to-day basis is still a lot like gambling. In fact, if you bought an S&P 500 index fund each morning and sold it that afternoon, 53% of the time you would make money, 47% of the time you would lose money. The odds of hitting black on the roulette wheel in a casino is about 47%, so really not a drastically different outcome. And the point of showing you the S&P 500 index is to show that you can't outrun market risk through diversification. The only antidote for that is time. Hey, if the information in this video is useful or helpful to you, please show your appreciation by clicking the like and subscribe buttons below so we can keep making content to help people learn about finance. So now I want to show you how long-term ownership of stocks actually serves to bolster your portfolio against market risk. There's a correlation, in other words, between the longer you own a basket of stocks and how much market risk you're actually exposed to. Now, most of the news you see about companies, stocks, the economy, things like that is bad news. That's the kind of stuff that gets clicks. It gets people's attention. Unfortunately, that's the kind of thing we're exposed to on a day-to-day basis. What you don't hear about is the innovation and the hard work and the way people get up each and every day in this country and show up to work and they get things done. Slowly, quietly, steadily building the American economy. Of course, talking about the way our economy moves forward is kind of like watching a glacier move down a mountain. It's sort of boring. But over time, all those little negative events that happen that occur to a company or a stock or the market at large, they get absorbed by all these great things that people are doing every day. All the boring stuff just sort of runs over all that negativity. And what we ultimately have is a burgeoning, growing, thriving economy that produces great investment returns for those who invest in the stock market. Now, to illustrate this, here is a picture of the S&P 500, again, the same Google snapshot, over a period of 5 years. Now, obviously, there are ranges within this timeline where you could have bought the S&P 500 index and lost money if you sold it, but if you actually held it at any point until the date that this was pulled, you'd have made money because when I pulled this, it was at an all-time high, which I didn't really mean to do, but that's just the way it kind of happened. My real point is that most of the time that you buy in this 5-year period, you would have made money, even if you did sell at another period. Even if you tried to lose money, there aren't many windows in here that you could have done that. You know, just looking at it, I haven't calculated it, but I would say in this 5-year window, around 70% of the time, if you'd have bought the S&P 500 and held it for nearly any period of time, you would have made money, which needless to say are far better odds than 53% that we were talking about in short-term ownership before. In fact, over the last 25 years, the S&P 500 has failed to close a year below its starting point only 6 times. That means 76% of the time, if you bought the S&P 500 on January 1st and sold it on December 31st, you would have made money. And only twice since 1978, if you'd have bought the S&P 500, would you have had to wait more than 2 years to recover your money if you bought it at a really bad time. And if you'd have bought the S&P 500 index at any point and held it for at least 7 years, you would have made money. The longer you hold it, the more likely you are to experience success. Not only that, but since its inception in the 1950s, the S&P 500 has returned about 10.67% annually. That's doubling your money every 7 years. We got another chart on the screen showing you back as far as Google would let me pull, I think back to 1984. So about 40 years of S&P 500 returns. You can see the way it just over time becomes almost like a hockey stick. It grows much faster at the end. That's because of the effects of capital appreciation, of compounding interest and inflation, things like that. But like we said, the longer you hold it, the greater the odds of success. So I hope the point is clear enough. Day trading stocks, owning stocks over the short term, I can't make an argument that it's not much like gambling. I think it is. I think it's very close to gambling. In fact, it's legal, but it's still a gamble because you don't know what prices of stocks are going to do in the short term. On the other hand, those who say that owning stocks is gambling, period, are wrong. The longer you hold the stock, the safer you make your investment and more resilient you make your investment against market risk. And it's absolutely a safe way to build wealth. And it's really the best way to build wealth, if we're being honest. So there you have it. Day-to-day trading of stocks, your success rate is about 53%. Annual trading of indexes like the S&P 500, your success rate is around 76%, and if you hold it for 7 years or more, it's basically 100%. We got lots more on our website and our YouTube channel about stuff like this. Please check that out if you have time. As always, we're grateful for your interest in our videos. God bless and take care.